Hello everyone, welcome to the next part of our macroeconomics free lecture. Well, the circumstances are different than usual, but let's hope that we will manage to find our way to cooperate in terms of providing you the macroeconomic content, the content of the course. Well, anyway, so let's jump into the description of the main parts of the slides that I posted you yesterday. A big bracket, you also know what are the particular requirements that I gave you to do. So you have two readings, one from the old textbook, one from the new textbook. You have an assignment, which is in fact not an assignment because you are not obliged to send me anything on Moodle. It's just for your own training on the understanding of the content of the lecture. Plus, you have one more thing to do, that is watching two movies. Now, The Insider Job and The Big Short, two very interesting movies that will give you some further ideas of the mechanism and the consequences of the financial crisis of 2008-2009. Because the financial crisis is the main subject of today's lecture, I changed the order of the lectures on the one hand because this particular lecture is something which is a bit more self-content. So I hope that you don't need that much of explanation to what is essential to understand those mechanisms. Comparing, for example, to the medium-run economy, which we will take up for the next lecture. Secondly, it also relates very much to what is happening right now, or what we expect to see right now in the global economy, so that maybe it is worth to know those particular mechanisms of the previous crisis in a more detail, so that you can draw conclusions about the current situation, compare the current situation and the past situation, and see, or discuss at least what measures the governments can take to try to prevent the economy from jumping into really severe recession in the worst case scenario. And that is also a part of the assignment I asked you to think about in the email yesterday. Just think about what are the similarities and differences between the crisis of 2008-2009 and the current macroeconomic situation. Okay, some details are there in the email. Okay, so I will not talk about the whole lecture. I hope that this lecture is very much self-content and self-explanatory. If you combine this with the two readings, and if you combine this with the two movies I requested to watch, but there are some details which I guess are worth explaining because they are significantly extending the knowledge of a standard bachelor student about the mechanisms of the crisis. And these are exactly the points which are described here on slide number 7, especially point number 2. The new financial instruments, which I would like to briefly describe right now, hopefully in a couple of minutes. Okay, the rest I hope that you get it from the slides and from the readings. If not, please leave comments under the YouTube video, okay? Because the video hopefully will be posted on YouTube if I manage to do this. I think I will do. No worries. So please, if you have some comments, if you have some questions, please put everything there, okay? Below the video. All right. So now let's move to the content that I would like to explain to you a bit in more detail. So the 7 steps, going back a bit, 7 steps that in general resulted in the recession and the crisis are just those here. We start from the bubble on the housing market in the United States. We go through the new financial instruments, the risk in the financial sector, defaults, and the losses on mortgages and other securities, bankruptcies of huge financial institutions, and finally we are at the last point. As I said, Hopefully everything is self-explanatory. One thing that should be totally new for you is the point number 2, which I'm now immediately moving to, which tells us a story about new financial instruments that were invented by the financial sector. Some of them were invented in already 1970s and 1980s, only to reduce the risk of financial investments. So those financial instruments allowed investors to reduce the level of risks in their portfolios of assets. How ridiculous this sounds when we know what consequences those instruments made for the global economy in 2008, 2009. But exactly this was the purpose of those instruments, which we call financial derivatives. And the name, of course, reminds you this mathematical derivative, which is the first derivative of a function. It has nothing to do with this. The only thing it has to do with this is that the derivative, a financial derivative, is an instrument whose value is derived from a value of a different asset, different base, different financial instrument. And this is very often a nonlinear complex function. So there is an underlying instrument behind the derivative, and the price of derivative is a complex nonlinear function of the price of the underlying base asset. Okay, that is why those derivatives allowed to have huge leverages, huge profits, huge nonlinear payoffs from the fact that the underlying instrument changed only slightly in price. And that is why they were very often used, started to be very often used by speculants, by people who wanted to speculate in order to profit a lot from very small changes in the prices of underlying base instruments. And one particular group of those financial derivatives are credit derivatives, which is a group of derivatives with a credit as an underlying asset. Credit meaning any type of credit. It can be a loan, it can be a mortgage, and hopefully all of you know what a mortgage is. A mortgage is a specific credit which is taken by individuals to buy property, real estate, houses, apartments, and so on. And what is characteristic about a mortgage is the fact that this mortgage, this type of credit is backed by so-called collateral. So new vocabulary. Collateral. Collateral is a specific asset that saves the repayment of the credit. For a mortgage, the structure is that if you take a credit for a house, the whole house is the asset that guarantees that if you stop paying back the mortgage, the bank will take ownership of the home, sell it on the market, and repay the credit. So that the bank is reducing the risk of your mortgage not being paid. Okay, and this means that there is a collateral, collateral to this credit. This value of the house is the collateral that guarantees to the bank that the mortgage will be paid, even if you don't pay it back, because, for example, you lose your job or you simply don't want to pay it. Okay, and this is something specific which will play a significant role in the evolution of the financial crisis. All right, so we have the derivatives, we have credit derivatives, and why those credit derivatives were so commonly used and popular on the financial markets. Because financial markets are mainly depending on the credit. There is huge credit in the macroeconomy, not only for buying goods, buying property, but also for buying financial assets. And credit derivatives allow to transfer credit risk between counterparties in a super simple way. These are standardized instruments that are very easy to trade, that have very standardized properties. For example, you could have bought a credit derivative for a given duration of time, for a given quality of credit, and the quality of credit is mainly measured by credit rating of the issuer of the instrument. And you could buy also a credit derivative for a different type of payments, fixed interest payments or flexible interest payments. Okay. And what is more, and this is, I think, the most important point for understanding why credit derivatives were so popular at some point, is that they offered high returns with theoretically low risk. For those of you who are more proficient in statistics and probabilistics, this comes down to the so-called law of large numbers. Law of large numbers. And the fact that if you draw probabilities from a distribution, from any distribution, in the long term, if you have many draws from this particular distribution, you will converge to a particular distribution. This is a Gaussian or normal distribution with a given mean and a standard deviation. And this is what people thought that microeconomic processes look like in terms of, the risks related to those credit derivatives. They thought that those risks are uncorrelated, unrelated with each other. Therefore, they underestimated the risk of those credit derivatives. And that is why they were wrong, because apparently all of those financial investors, those quantitative analysts and the investment banks, they had wrong models in terms of pricing those credit derivatives, so that those instruments were overpriced. People believed too much in their safety, and that is why they collapsed at some point. When they collapsed when those negative events took place, and there was a chain of reaction that actually realized, and this proved that this assumption about uncorrelation of particular events that leads to payment from this credit derivative was something that was incorrect, was incorrectly assumed by the analysts. Okay. So two of those credit derivatives which were fundamental for the outbreak of the financial crisis in 2008-2009 were the CDS and CDO. Let's go step by step. CDS, credit default swap, is nothing else but a simple insurance contract. The same contract as you might have for your car insurance, or your parents have for your home insurance. The only difference is that the risk against which you are insuring is not the fact that your car is going to be damaged, or your home is going to be flooded by Alzette. Is that the credit event that we are insuring against is the bankruptcy of a third party, of another financial institution or a corporation or a country. Okay, so bankruptcy of an institution. But the mechanism of the CDS is very simple and as identical almost to a standard insurance contract. So the insured party pays insurance premiums every month or every quarter or every year, while the insurer, that is the company that is issuing this CDS or the insurance, declares to cover losses in case of this bankruptcy. Easy. What about the second credit derivative that was instrumental for the outbreak of the crisis? The CDO, which is the abbreviation for the collateral debt obligation, is a bit more complex instrument. This credit derivative was used by banks to get rid of some assets from their balance sheet. To put it differently, banks wanted to sell some assets from their balance sheet to get cash instead. When you sell something, you get cash instead. Put the cash into their balance sheet and buy more of those assets. Okay, why they had to do this? Well, because banks are regulated, and even in those times of early 20th century, banks were regulated, and banks couldn't do whatever they want with the money they have. Okay, which means that if you take too many credits as a bank, so if you give too many credits as a bank, your balance sheet is becoming too risky, and you cannot do this. So what you can do? You can exchange those risky assets for assets which have zero risk. And what's the asset that has a zero risk? Well, of course, this is money, right? This is the currency, the money, cash. So they invented this instrument to be able to exchange risky assets, on which of course they made profit, for the cash, for money. And this general process is called securitization. Securitization. I'm not sure if some of you heard this name before, but in the coming slides I will explain you what is this. Okay. So here we have two schemes that describe the functioning of those two credit derivatives, the CDS on the top and the CDO on the bottom. So in the CDS, once again, I repeat, there are two sides of the contract: the protection buyer, that is the guy who wants to insure himself from the risk of bankruptcy of a third reference entity, which can be, totally any entity that you can think of, any firm, bank, or country even. And there is a protection seller, which was a big insurance company or financial institution that guaranteed that if the reference entity is going to be bankrupt, this protection seller will pay to the protection buyer the amount on which they agree. Okay, it could be $1 million, could be $1 billion. It depends on the contract. But there is, of course, a price for getting this insurance. The protection buyer declared to the protection seller that he will periodically pay the insurance premium. Let's say 40 basis points for every unit of the CDS bought. And this is a standard insurance contract. No rocket science there. CDO, as I mentioned, is a bit more complex. So imagine that we have a situation of a standard bank that is giving many of those mortgages. The balance sheet of this bank is becoming riskier and riskier because the bank is accumulating those mortgages, and at some point the bank is capped by the regulations and has to do something with its balance sheet because the balance sheet is too risky. So we have this bank, which is here represented by this XY corporation, whatever. We have those obligors that are taking the loans, and you see this arrow here that goes from the banks to obligors. That these are the transfers of funds for example, buying real estate, the mortgages, so that the mortgages are initially on the balance sheet of the bank. So what the banks invented? Well, the banks invented the securitization process, which means that they could actually pack those mortgages into a financial instrument and sell it to investors. So how they did this technically speaking? So banks created so-called special purpose vehicles. These were artificial companies, the purpose of which was only to buy those mortgages from the bank. And this is represented by this arrow with the name A. So the pool of assets, let's say mortgages, was transferred from the bank to the special purpose vehicle. Why? Because the special purpose vehicle is the artificial firm that is now repacking those mortgages, creating a CDO out of this, and selling them to financial investors. This is this line B. We will talk about those things just in a couple of minutes. These are the investors who are buying the assets, the CDO. Okay. And of course, the bank exchanged now the mortgages for cash. So the cash is flowing now from the investors to the left-hand side, to the SPV, to the left-hand side, to the bank. So bank is left with cash, a zero risk asset in the balance sheet. All right. Now, what's happening when the CDO is going up? Of course, the mortgages are now being repaid by the obligors, and home mortgages are owned by investors. So what is happening now is that the interest payments and the installment payments of those mortgages are now transferred from the bank, from the obligors to the bank, to the SPV, and to the investors. So investors are receiving the payments from mortgages through the SPV. So you see this that this structure is a bit complex. You have a bank who cleared its balance sheet with the credits they gave. You have investors who bought a financial instrument that gives them the right to receive interest payments and installment payments from the obligors. Okay, so everything works perfectly when the credits are repaid on time by the people. Okay, everyone is winning there because banks are winning. They sold already the credits with a profit, but now with the new cash on the balance sheet, they can issue even more mortgages, because they can take more risk with their assets, with their balance sheet. Investors are happy because they make a profit with relatively low risk, because they believe in the law of large numbers and low correlation between the probability that different obligors are not going to repay the credits. And this is the mistake they made in terms of pricing the whole value of CDOs. And the SPV is something totally artificial, which is a share table and laptop company that simply artificially transfers a pool of assets from the bank to the investors. Now let's focus on this particular part of our graph, that is the repayments of the credits. And let's imagine that those repayments are okay. This comes in a minute. So are those repayments structured in the CDO? Well, normally you would assume that those repayments are uniform for all the holders of the CDO, but it's exactly what not happened in the CDO. Actually, those repayments were sliced into so-called tranches of different level of seniority: senior tranche, mezzanine tranche, equity tranche. And there was a structure of the CDO which, for example, constituted 80% out of the senior tranche, which was the highest quality part of the CDO, 15% of the medium quality tranche, and 5% of the lowest possible quality. Then some intelligent people invented that they can also slice this medium risk tranche of the CDO into, once again, the senior, medium, and low quality tranches. What is important here is that those tranches, those parts of CDO, were actually different financial instruments. So if you wanted to buy a AAA rated, which is the highest possible rating instrument, you could buy either the governmental bond of the United States or Luxembourg or Germany. These are AAA rated. You could buy a treasury bill, which are the safest papers which are issued by the Federal Reserve, the US Central Bank, or you could buy this AAA rated tranche of the CDO, which are actually what? Well, repayments of the mortgages. And this was rated AAA. Imagine how ridiculous it sounds, but it was rated AAA. Why this is ridiculous? Well, because of the structure of the repayments. So the way that those repayments, those repayments from obligors were transferred to investors. They were not transferred uniformly. They were transferred according to those hierarchy of tranches. So imagine that those flows of payments from the mortgages are like flows of water from a pipe. Like literally flows from water. This is a pipe, and through this pipe there goes water, a particular flow of water. And we have three containers here. A reservoir number one, which is called the senior tranche, the second one, the medium quality tranche, and the equity tranche, the lowest quality. So the structure of repayments of mortgages in the CDO was as follows. So first, the senior tranche was filled with repayments, or filled with water. So the first reservoir was filled with water, and until this reservoir is filled, the rest is not getting anything. The mezzanine tranche gets repayments only if the senior tranche is fully repaid. So if all the owners of the senior AAA rated tranches of the CDO received their payments from the mortgages, only then the medium quality tranche is being repaid. And after the medium level tranche is repaid, then the equity tranche, the lowest priority tranche, is being repaid. So you see the difference in the exposure to credit risk for those different tranches. And this, people realized, investors knew that this equity tranche is something which you want to gamble on. This gave you extremely high returns, but it was of so poor quality that it was not even rated by rating agencies, because there was not such a bad indicator of credit risk for this particular financial instrument. But of course, there are people who want to gamble, And as long as people realize that this is something super risky, everything is fine. Because those who wanted to invest safely, they never touched this particular part of the CDO. Okay? Fair enough. The problem with the CDO was that when the repayment stopped, it's not only the equity tranche that was hurt by those stop in repayments. It was also the mezzanine tranche, and oftentimes, and actually in the later part of the crisis, it was the rule that even the senior tranche was not receiving enough flows from the repayments of those mortgages, which means that this AAA rated instrument was actually not at all AAA. It gave you huge exposure to credit risk of the guys who were taking the mortgages. And why it was so? Well, you know it from the previous slides that the mortgages that were given later on were called subprime. They were not high quality mortgages. They were low quality mortgages. People who got those mortgages should never have been awarded a mortgage. They had a low level of assets, no job, no income. Actually, they were called ninjas. Okay, so they had no income, no job, no assets. Okay, so they were ninjas, and those ninjas were actually getting mortgages. And of course, they stopped repaying those mortgages when the crisis started. So what was the situation of the bank? Well, the bank had already cashed out. They had money in their balance sheet, so they were totally safe. What was the situation of investors? Well, they were owning financial instruments that were not giving them the actual flows that they expected. Moreover, those instruments were of lower quality than they actually were advertised, and this brought huge problems on the financial market. So even the senior tranches were not repaid. And the scale of the problem you can see in this graph. So this is the maximal capitalization of this asset-based securities, including CDOs and other mortgage-based securities. This indicates something like $3.3 trillion of dollars. So this is 3,000 billion, $3.3 trillion of dollars. This was the capitalization of the market. Compare it to the US GDP for year 2007 and the world GDP for year 2007. This is a quarter of US GDP and around 5% of world GDP. This is a huge amount of money. And all of those instruments lost almost entire value in the span of, 2 or 3 years. So you see what was the magnitude of the losses and which were encountered by the financial sector. All right, so hopefully the rest of the presentation is more or less okay. So the only thing that you should remember from those slides about the new financial instruments is the definition of the derivative. By the way, there is a question about finding some actual derivatives traded on financial markets. It's up to you. That is why I didn't give you any idea what a derivative can be. You have to Google it yourself. The definition of a credit derivative, a general idea of what a CDS is, insurance, and a general idea of what a CDO is, well, a way of getting rid of your assets, of assets from the balance sheet. This is a bit more complex. Hopefully you got the mechanism of securitization here for the CDO and the way that payments from the CDO were made with those tranches of different quality, of different seniority, and of different hierarchy of payment. All right, so what's left here for the presentation? I leave you to study this yourself. Please also have a look at the readings that I sent you on Moodle, plus the new version of the textbook. There is also a nice 10-pager of the describing the mechanism of the crisis. And the last thing I would like to ask you to do is to do this. Therefore, this means watching the 2 movies. Inside Job and The Big Short. You have a bit more time, hopefully, to spend at home. So have a look. Hopefully, it will improve your understanding of of the mechanism of the crisis. And remember, if there are some questions, if there are some comments, please leave them in the comment section below the clip on YouTube, so that we stay in contact. So the next presentation in 2 weeks, it will be about this medium-term model, which I still ask you to read from the textbook. This will require a bit more work from my side. That is why I switched those presentations. I need a bit more time to prepare the lecture, to have the movie ready. And by the way, I think I will make a poll on whether you would like to have this lecture on a live stream or with a recorded clip as now. So just give me your opinion. I will put this voting on Moodle hopefully soon. Okay. So keep safe. Stay at home as long as you possibly can. Don't leave homes for unimportant things, so that the disease does not spread and we are not in an even worse situation. It's very important to be socially responsible. It's not about your health, it's not about my health, because we are more or less protected from the coronavirus. It's more about the older people, so that's, we are all responsible, we don't do stupid things, and we stay at home. Okay, so see you hopefully in coming days, and we stay in contact regarding how further we will proceed. And please leave comments and questions in the comment section on YouTube. Have a good week, have a good 2 weeks, and see you hopefully in the coming days.